Coca Cola and PepsiCo, two iconic brands, two dominant forces in the beverage and soft drink space, two cash printing machines, and two Dividend Kings. In today's video, we are going to take a look at both of these awesome companies. We're going to break down their most recent results. We're going to take a look at valuation and also look at their current dividend statistics to determine which of these stocks is the better buy right now. If these types of videos interest you, then let me know by hitting that like button down below and consider subscribing to the channel. Now that you've done that, let's jump into the video. Before we begin, let me start by giving out a huge thank you to The Motley Fool for sponsoring today's video. If you go to fool.com/Mark, you could sign up to receive their top 10 stocks to buy now. All right, let's take a look at Coca Cola and PepsiCo to determine which is the better buy right now. Both of these companies have been very consistent and safe investments for shareholders over the years, and one of those reasons is because they dominate their space. They have very wide moats. And you may be asking yourself, what does this mean to have a wide moat? Well, exactly what I just mentioned is that they dominate the sector, and it is a very high barrier to entry. There's no new beverage companies or snack companies that are going to go out there and take meaningful market share from either of these two giants. That is the definition of having a wide moat. And this is a key thing that Warren Buffett has looked for when investing in companies. Let's begin with the Coca Cola Company, stock ticker KO. The Coca Cola Company was founded back in 1886. That is 100 years before I was born. The company currently has a market cap of $256 billion. And on the year, shares are pretty much flat, sitting at a gain of 0.8%. Now, when you look at the S&P 500 as a whole, the company is actually outperforming the entire market, which is sitting at a negative 20% return right now. Over the past 10 years, Coca-Cola slowly has seen their revenues decrease from the start of 2013 through 2018. But since 2018, outside of the pandemic year in 2020, the company has returned to revenue growth, and that is expected to continue moving forward given the latest guidance that they are indicating we have seen from the company, which we will discuss in a moment. What happened in 2018, you might ask? Well, it actually happened right before 2018, and that's when new CEO James Quincey took the reins as CEO and chairman of the Coca-Cola Company. So 2018 was really the first year under his full control where he started implementing new ideas for the Coca-Cola Company moving forward. One of those ideas, which has had the greatest impact, I believe, on the company, is actually reducing the amount of SKUs, reducing the amount of products that the Coca-Cola Company has, focusing on what works best and what has the best margins for the company to be able to return money back to shareholders. The Coca-Cola Company is trying to appeal to budget-conscious consumers through product offerings like value packs in North America that contain fewer cans or use smaller bottles. Inflation has also been an issue, as you can imagine, over the past 12 months, and to combat this, the company has been forced to increase prices on multiple occasions, and yet they have not seen much of a dip at all in demand. In fact, unit case volume grew 4% during the most recent quarter. This speaks not only to the brand loyalty, but the demand that we continue to see for Coca-Cola products. Speaking of demand, let's take a look at how the company has performed over the past 12 months. In terms of revenue, the company has generated $42.3 billion. That equates to revenue growth of 12% year over year. In terms of operating income, the company has brought in $10.5 billion. Adjusted earnings per share is at $2.48 per share, which equates to EPS growth of 5.5%. Next, let's turn to valuation. Analysts are looking for Coca-Cola to generate 2023 EPS of $2.52, which equates to a forward price to earnings multiple of 23.5 times. Now, over the past 5 years, which is the blue line on this chart here, Coca Cola shares have traded closer to an average of 25.3 times. So right now they are trading well below their 5-year average. Looking at free cash flow, which is a very important thing to look at, especially with dividend stocks, free cash flow per share over the past 12 months was $2.31 per share, which equates to a price to free cash flow multiple of 25.7 times. Management expects currency and inflation headwinds to persist over the course of the next 6 to 12 months. Now, let's quickly turn our attention to the dividend. The company pays an annual dividend of $1.76 per share, which equates to a 3% dividend yield. The dividend is still safely covered with a 70% payout ratio. Now that is reaching the upper echelon of where I like to see payout ratios, so it's definitely something to keep an eye on, but nothing we have to worry about in my eyes currently. In terms of growth, shares of KO have one of the largest dividend growth track records to date. With the dividend increase they did in February, the company now has increased their dividend for 60 consecutive years, firmly supplanting themselves as a dividend king. Next, let's turn to Coca-Cola's major competitor, which is PepsiCo, stock ticker PEP. PepsiCo was founded also in the 1800s, back in 1898, so really only 12 years after the Coca-Cola company started. The company currently has a market cap of $249 billion. On the year, shares of PEP are slightly up at 3% gains, easily outpacing the S&P 500, which we talked about being down over 20% on the year. Looking at this 10-year revenue chart for PepsiCo, you can see they have largely had an upward trajectory, with revenues reaching $83.6 billion over the past 12 months. PepsiCo is a beverage company, but they're actually really a snack company first and foremost. The company's largest segment in terms of revenue is Frito-Lay, segment which sells brands such as Fritos, Lay's, Doritos, Cheetos, Ruffles, just to name a few. The segment accounted for 47% of the company's operating income in Q3. Here is a look at some of the other brands that they own and have partnerships with, including Gatorade, Mountain Dew, Aquafina, Lipton, Tropicana, Quaker, Sun Chips, and many more. Pepsi is a global leader in the snack sector, which is something that attracts a lot of investors, the diversity you get within the portfolio of PepsiCo. Like the Coca-Cola company, PepsiCo has also been dealing with these higher inflation, higher supply costs over the past 12 months plus, meaning they've had to increase prices and pass some of those increases that they've seen onto consumers, but they have yet to see much of a dip in demand. During the most recent quarter, beverage volumes were actually up by 3%. Meanwhile, convenient foods saw a slight dip of 1.5%. However, on the year, the beverage segment has seen an uptick of 5% on volumes shipments, and the convenient food sector is up 1.5% on the year. So still seeing that demand across the entire portfolio over the past 12 months. This again, like Coca-Cola, speaks to the brand quality and brand loyalty that both of these companies have. Let's now take a little bit closer look at the financials and what the company has generated over the past 12 months. In terms of revenue, the company has generated $83.6 billion, which is nearly double that of the Coca-Cola company. But remember, they have an entirely different portfolio, not just beverage, but they also have the snack portfolio, or the food side, which is actually larger. Revenues have increased over the past 12 months by 9%. The company generated operating income of $9.9 billion. Adjusted EPS came in at $6.65 per share, which equated to 11.2% growth year over year. Now taking a closer look at valuations. Analysts are looking for 2023 EPS of $7.30 per share, which would equate to a forward price to earnings multiple of 24.5 times. And as we can see on this fast graphs chart, over the past 5 years, shares of PepsiCo have traded closer to an average multiple of 24.8 times. So really where they're trading right now is very fairly valued based on their recent 5-year history. In terms of free cash flow, the company has generated free cash flow per share of $4.60, which equates to a price to free cash flow of 38.9 times. Now let's quickly turn our attention to the dividend. The company pays an annual dividend of $4.60 per share, which equates to a dividend yield of 2.6%. The dividend is still safely covered with a 67% payout ratio, slightly below that of Coca Cola, but not all that different. In terms of dividend growth, PepsiCo increased their dividend last quarter, which ended up making 2022 the 50th consecutive year of dividend growth, now officially crowning them a Dividend King. All right, now we know a little more about both companies. We know how their recent results have turned out over the past 12 months, and we've taken a closer look at their current valuations. So you may be asking, Mark, which is the better buy? Well, for starters, both companies are amazing. The Coca Cola company has been king for many years, very consistent, but they started to lose sight of their former self. And since then, James Quincy has come in and under his CEO leadership, and he is lessening the amount of products they have. They just got overstretched. He's lessening those to focus the most in-demand products that they have, and we are seeing how some of that is starting to play out as the company returns to growth. PepsiCo is also awesome. They have a very wide range, a bigger portfolio by not only having the beverage side of things, but they also have the snack side of things, which makes it a little bit more of a diversified play on the beverage and snack industry. With that being said, I'm going to side with the Coca Cola company. And let me explain why. I really like where the business is trending, where James Quincy is lowering and lessening the amount of products to focus on the most profitable products that they have. I also like how the company is operating. Over the past 12 months, we saw Coca-Cola with operating margins of 25%. PepsiCo, on the other hand, during the same time period, had operating margins of just 12%. Also, in terms of valuation, Coca-Cola just looks way more intriguing to me. Coca-Cola's trading at a forward multiple of just 23 times, even though they tend to trade at a higher premium than Pepsi. So they're trading below Pepsi right now in a forward at 23 times, where Pepsi is more at a 25 times multiple, which is more in line with their 5-year average. Free cash flow, looking there, that is always a key one that I look at. And free cash flow per share right now is a very, very wide margin. Now there's a lot of things to play out based on the past 12 months, so that's something that can change, but right now is the question, and Coca-Cola trades at a price to free cash flow multiple of just 26 times, whereas PepsiCo is trading at 39 times. Both companies are very stable businesses and great companies to have in your dividend portfolio. Down in the comments section below, let me know which of these you prefer. Is it the Coca-Cola company or PepsiCo? Thank you again for watching, and thank you again to The Motley Fool for sponsoring today's video. Again, go to fool.com/Mark to get their top 10 stocks to buy now. And with that being said, thanks again for watching. We'll see you in the next video. Take care.